It happened again. The price of silver was at an all-time high, and I bought it. The rational part of my brain screamed to wait, to be patient. But there was another voice, quieter, more instinctive. It was the voice that understands the difference between a number on a screen and a real, tangible thing you can hold in your hand. The price we see, the one that flashes on financial news channels, is a paper promise. What I was buying was a physical object. This story is not about a prediction. It is about a disconnect, a vast, quiet, and monumental imbalance between the world of paper promises and the world of physical reality. Today, we will follow that imbalance into the depths of the financial system. We will see how it is possible for the official price of something to tell one story, while the actual physical market for that very same thing tells a completely different and far more urgent story. The official action is simple to state. The price of silver reached a new record high. For most people watching the markets, that is the entire story, a ticker tape moment. An asset class had a good day. But to stop there is to miss the entire point. The price is a signal. It is a piece of information generated by a specific market under a specific set of rules. That market is the futures market. It is a place where contracts for silver are traded, contracts that promise the delivery of silver at a future date. Very few of these contracts ever result in the actual delivery of a bar of silver. They are promises to deliver or promises to pay the difference in cash. This is the paper market. It is enormous, fast, and leveraged. It sets the global benchmark price, the one we all call the spot price. When that price hits an all-time high, the official story is one of strong demand. It is a story of investors, perhaps fearful of inflation or seeking a safe haven, piling into silver. This is the narrative that flows through the media. It is clean, logical, and easy to understand. It matters because this official price is the foundation for thousands of other financial products and decisions. Mining companies plan their operations based on it. Jewelry manufacturers hedge their costs against it. National banks might consider their reserves in its light. It is the North Star for the entire silver ecosystem, or at least it is supposed to be. But what if that North Star is flickering? What if the light it casts is an illusion, a phantom signal from a world of paper that is slowly losing its connection to the ground? The significance of the all-time high is not necessarily that silver is more valuable in that moment. The significance is that this specific mechanism for measuring value, the futures market, is registering a profound level of activity, of tension. It is the system's own thermometer spiking. The question we must ask is not just why the thermometer is reading high, but whether the thermometer itself is broken. Whether the patient, the real physical market for silver, is in a state the paper thermometer can no longer accurately measure. To understand that, we must leave the clean digital world of the futures exchange and step into the physical market. This is a different universe. Here there are no flashing tickers, only the heavy weight of metal. This is the market of coin shops, of private refineries, of industrial fabricators who need silver to make solar panels and electronics. In the paper market, when you buy, you receive a digital entry in an account. In the physical market, when you buy, you receive a box. The contrast between these two markets has never been starker than during these periods of price discovery. In the paper market, the price can move with breathtaking speed, fueled by algorithms and leveraged bets. $1 billion of buying pressure can be applied with a few keystrokes. In the physical market, movement is slow, deliberate, and constrained by brutal, unyielding realities. You cannot create a silver bar with a keyboard. It must be mined, crushed, refined, poured, assayed, and transported. This process takes time, immense energy, and capital. When the paper price screams higher, the physical market does not instantly respond with a flood of new supply. It responds with a simple, silent mechanism, the premium. The premium is the extra cost you pay over the paper spot price to actually get the metal into your hand. It is the market's real-time vote on the validity of the paper price. In calm times, the premium is modest, a small fee for the service of fabrication and dealer profit. But when stress enters the system, the premium explodes. It becomes a canyon between the paper world and the real world. You will see a paper price of, say, $30 an ounce, but walk into a dealer and the cheapest ounce you can buy may cost you $45. The paper market says one thing. The physical market, where goods actually exchange hands, says something entirely different. It says there is not enough metal to go around at that paper price. It says that if you want real silver, right now, you must pay a real price that the paper market is not yet brave enough to acknowledge. This is the first and most visceral crack in the official narrative. The all-time high on the screen is not the all-time high on the street. The real price, the one that matters if you want to possess the asset, is often significantly higher. This discrepancy is not a minor glitch. It is a fundamental breakdown in the principle of price discovery. It tells us that the paper market, for all its volume and speed, is becoming unanchored. It is floating away from the physical reality it is supposed to represent, tethered only by the thinnest of threads, the fragile promise of delivery. Where does the physical metal actually live? To answer that, we must look to the vaults, Specifically, the registered vaults of the commodities exchanges, like the COMEX in New York. These vaults hold the silver that is officially available to settle those paper futures contracts if someone actually demands delivery. This inventory data is public, and it is one of the most telling indicators of physical stress. Over the past years, a quiet but relentless trend has unfolded. The total amount of silver in these vaults has declined, but more importantly, the amount of silver classified as registered, meaning it is in the proper form and available for immediate delivery against contracts, has fallen even more dramatically. Think of the total vault as a warehouse. The registered silver is the inventory on the shelves, ready to be shipped out to a customer who has an order. The rest is stored in the back, owned by someone else, not for sale to the exchange. The shelves are getting bare. The ratio of paper contracts claiming ownership of silver to the actual bars of registered silver available to deliver has ballooned to levels that are historically unprecedented. There are now hundreds, sometimes over 1,000, paper claims for every single deliverable bar. This is the supply side data, the cold, hard numbers behind the premium. The system is operating on a fractional reserve basis, much like a bank that has lent out far more money than it has in cash in its vault. It functions perfectly until the depositors all ask for their cash at once. In the silver market, a delivery demand is the equivalent of a bank run, and the vault data suggests the system is prepared for only a very small number of depositors asking for their metal at any given time. When we connect the dots, the soaring paper price, the exploding physical premiums, and the dwindling registered inventory, a picture emerges. It is a picture of a market experiencing a silent run, not a run driven by panic on the street, but a slow, persistent drain of physical metal from the official channels of the exchange into other hands, into private vaults, into strongholds in the East, into the hands of industries that consume it and individuals who simply want to hold it forever. The official price can rise to an all-time high, but if the metal to back that price is not there, then the price is not a measure of value. It is a measure of desperation in the paper world to keep up with a reality that is quietly slipping away. What is the motive of the large banks and institutions that are the primary players in this paper market? It is crucial to approach this question from a neutral, factual standpoint. These entities are not villains in a story. They are participants in a system, and they act according to the incentives that system provides. Their primary business in the commodities futures market is not typically to amass physical metal. It is to provide liquidity, to facilitate trading for clients, and to manage risk, both their own and their clients, through hedging. A bank might take the opposite side of a mining company's hedge or facilitate a pension fund's commodity allocation. In doing so, they often accumulate large net positions in the paper market. To manage the risk of these positions, they engage in a practice known as hedging or spread trading, which involves buying and selling different contracts to neutralize price risk. The motive is stability, predictability, and the collection of fees and spreads. The system is designed for this paper trading to flow smoothly, with the physical delivery mechanism acting as a rarely used safety valve. The incentive for these institutions is to keep that valve rusted shut. Actual physical delivery is messy, expensive, and disruptive to their finely tuned paper portfolios. Therefore, their actions are often aimed at suppressing volatility in the paper price. Sharp, runaway price moves are bad for business. They create uncertainty, margin calls, and can trigger those dreaded delivery demands. From this perspective, a steadily rising price might be manageable, but a volatile, spiking price that awakens interest in physical delivery is a direct threat to the smooth functioning of their model. Their actions in the paper market, which can appear as massive, coordinated selling at certain technical levels, can be seen as a form of risk management, an attempt to cool off speculative fever and maintain order. The motive is not necessarily to manipulate the price lower forever, but to keep it within a controlled range where the paper game can continue uninterrupted. The conflict arises when the physical market refuses to obey the paper signals, when industrial users and retail buyers ignore the paper sell-off and keep buying physical metal, draining the vaults. The institutions are then caught in a bind. Their paper maneuvers may win the battle on the screen, but they are losing the war in the vault. Their motive remains the same: manage paper risk, but they are increasingly doing so atop a physical foundation that is shrinking beneath them. While the institutions navigate this systemic bind, the individual investor experiences it on a deeply personal level. The psychology is a turbulent mix of conviction and confusion. You see the all-time high on the news, and you feel a thrill. You are part of a movement, your decision validated by the market. But then you go to buy, and you are confronted with the premium. The deal does not look as good. Doubt creeps in. Am I buying at the top? Is this a trap? The emotional roller coaster is exacerbated by the noise. On one side, voices proclaim the system is breaking and this is the last chance. On the other, voices mock metal holders as relics, missing out on the real gains in tech stocks. The retail investor is pulled between fear of missing out and fear of being wrong. The stacker, the term for those who accumulate physical metal, develops a unique mindset. It is a defensive posture. Each purchase is not a bet on a higher price next week, but a slow, deliberate transfer of wealth from a digital credit-based system into a tangible, non-counterparty asset. The psychology is one of patience, often tested. They buy an ounce, and the paper price drops the next day. The instinct is to regret, to feel foolish. But the seasoned stacker learns to reframe that drop. It is not a loss. It is an opportunity to buy the next ounce at a better price. This is dollar cost averaging not just as a strategy, but as a psychological shield. It transforms emotional reactions into a calm, mechanical process. The greatest psychological challenge comes during the explosive rallies, exactly like the one that created the all-time high. The urgency is palpable. The fear shifts from "I might lose money" to "I might never be able to get any metal at all." This is when discipline is paramount. The retail investor who has built a plan, who defines their stacking not by a price target, but by a steady allocation of savings, can navigate this. They may buy at a high, but it is just one purchase among many made over years. The investor without a plan, driven by the fever of the moment, risks exhausting their capital and their nerve at the worst possible time. They become a casualty of the volatility, their psychology shattered by the very market they sought to profit from. The empathy in this situation is profound. It is the understanding that everyone who chooses to step outside the mainstream financial narrative carries a weight of uncertainty. They are making a conscious choice to opt out of a promise-based system, and that is a lonely, often misunderstood path. Their psychology is not one of greed, but of seeking a foundation in a world that feels increasingly foundationless. Let us conclude by exploring scenarios, not predictions. Imagine a scenario where the current trends continue. The paper price continues to make new highs, but each high is accompanied by even higher physical premiums and further declines in registered vault inventory. The disconnect widens. The futures market might begin to experience repeated delivery squeezes, where those standing for delivery find fewer and fewer bars available. This could force an official response, a change in the rules of the game. Contract specifications could be altered, or cash settlement could be forced upon participants. This would be the formal admission that the paper market can no longer pretend to be a physical market. The two would officially divorce. The physical price would then be set solely by the actual buyers and sellers of metal, unchained from the paper derivative. It would likely be a number vastly different from the one we see today. Now, imagine a different scenario. A sharp recession hits, industrial demand for silver falls, the paper price collapses under the weight of liquidating paper contracts. The headlines declare the metal story over, but in the physical market, a different dynamic may unfold. While industrial demand slows, investment demand might surge as faith in the financial system wavers. The premium on available metal could remain stubbornly high even as the paper price crashes. This would be the ultimate revelation of the disconnect. The screen would show one reality, a crashing asset. The coin shop window would show another, a scarce commodity still commanding a high real price. For the individual, the lesson from these scenarios is not about timing which one will happen. The lesson is about understanding the landscape you are in. You are participating in a market with two separate but linked layers, a superficial layer of fast, leveraged paper and a deep, slow layer of physical reality. The tensions between these layers are reaching a point that may not be sustainable. The all-time high is not an end. It is a symptom of a system under stress, a system where the claims on a thing have vastly outgrown the thing itself. My purchase at that high was not a bet on a number. It was a small, deliberate decision to align myself with the deeper layer, the layer of reality. Whether the paper price goes up or down from here is almost secondary to the fundamental, unchanging truth that the physical world has limits, and paper promises, if left unchecked, do not. The story of the all-time high is not a story of a peak. It is the story of a widening crack, and a crack, once it starts, has a destiny all its own.